All right, what's going on? Welcome to the channel. In this video, I want to address some of the most commonly asked questions that you're asking both on this channel and in my DMs on Instagram and on TikTok. So with that in mind, let's jump right into this video. Question number one is, what hidden risk comes from using a virtual business address if you're looking to build business credit? I've spoken about this at length here on this channel, but I am going to give you, I would say, the main thing that you want to focus on, which is the validity of the business, which means, is the business that you're using one that the banks and financial institutions actually classify as a good business address? Like a really simple way of identifying that I can give you, which is low hanging fruit. And a good way of doing it is simply doing a reverse search on the business address. The first thing that you want to pay attention to is it a non CMRA, which is a non commercial mail receiving agency? Again, we've done videos about this at length, which are probably linked to this video. But the second layer that you want to look at is the business address that you're using actually one that has a clean record? Because not every virtual office address is created equal. Sometimes you can do a reverse search similarly to what you would do with a phone number. And the same way that it screens scan likely, you're most likely not going to pick up that call, most likely going to block it. It's the same thing that financial institutions and government agencies do if you're looking to pick up contracts. When they look at your address and they say, wait a minute, there are like liens attached to this address, whether that belongs to your business or not. There is bad media, bad press that's attached to your address, whether it belongs to you or not. Next question is, can I use a management company to structure and create a secondary stream of credit without affecting my main business? This is a high level question, which I absolutely love. So, the answer to this is going to be yes. You can set up a management structure if you're looking to open up a separate type of, I say, business funding or type like a business funding acquisition through another entity. What you want to make sure that you don't do, though, is that if your goal is to have two different types of businesses getting funding, you obviously want to make sure that you start from the bottom, which is the foundation. And so each of them is going to have its own EIN and it's going to have its own bank account. And then you want to run the transactions that are corresponding to each of those separately. Reason for this is because you have something called the corporate guarantee, which I'll probably get into a little bit later on in this video. But a corporate guarantee is kind of like a personal guarantee, which you're using your personal credit to co-sign and to personally guarantee on behalf of the business to get access to capital. You can do the same thing with a corporate guarantee. The issue is that if your goal is to have these two separate, then you don't want to have a corporate guarantee structuring in them. You want to have the funding set up for this one, which we help our clients do all the time with simple funding setups. And then you want to have a funding setup for this one individually. So this way, LLC one, which is the management company, gets its own funding, gets its own capital, and then LLC two, whatever it is, whether it's real estate, cosmetics, consulting, whatever it is that you're looking to do in this main business right here, it keeps its own line of credit, almost like its own identity as well to capture its own credit lines. Question number three is, how can I protect my primary entity from appearing high risk other if I have other high risk businesses? I see what you mean. So the main thing is kind of, I'm going to piggyback off of what I just mentioned just now. If you're looking to set up two different types of funding systems for two different businesses, you want to keep separate the what you're spending on the business side and then what you're spending on the personal side. Meaning, what you spend, actually, not what you spend on the personal side, what you spend on the business side. Not bad. That's like another way to commingle funds. What you spend on this business front and what you spend on this business front, you want to keep those separate. So if you have a business bank account for your holdco, and let's say that holdco just receives the management fees, any expense that happens on the holdco side, like keep that separate from what happens on this entity side. So let's say that this entity right here is a real estate front. And I was actually just talking about this to a client of ours. Anything that happens on the real estate front, you want to just have it logged, because if not, a really good lawyer is going to be able to say, hey, wait a minute, these two businesses aren't actually separate because they're actually commingling their expenses and their assets. And so this is why you want to have everything happening on this front separate from what's happening on this front, because it's going to allow you to keep the high risk of what's happening in one business separate from the other, because the banks are going to say, oh, these are two separate ledgers, or these are two separate ledgers. If a lawyer happens to get in there, they're going to say, oh, these are two separate businesses. So we can only come after said business. And so any high risk transaction that's happening on this side is only going to be kept on this side. Next question is, are there any specific times of the year where banks are more likely to approve funding limits? Yes. So again, another video that I've gone in depth on, but I'll hit it here, which is you essentially have two different things that you want to pay attention to. You have the fiscal year, which is what banks operate off of, which is how they manage their books. And so depending on what's happening each quarter or what's happening just in the economy as a whole, that's how they're going to dictate how much they're either going to press on the gas with how much funding they're going to allocate to businesses or what they're going to pull back on. That's on the macro side with the fiscal year. If you're looking at it from your business standpoint, which is something that I can control, so if I know that in my business, this is known as cash flow cycles. I know that prime time for us is summertime, as an example. So let's say that if I know that the majority of our revenue comes in from the summer, either from an industry standpoint as a norm, or just our business as a whole, and I have the books to show for it, meaning, hey, this is the cash flow of how it looked over the last 24 months. This is how our taxes looked over the last 2 years. Then I can flex that. And so there's two different things that I do with clients in situations like this, especially with cash flow cycles, which is what I can have control on when it comes to seasonality of a business. I would either A, fund the business before going into that round of funding, meaning I'm already setting it up, knowing that I'm going to have a good amount of cash flow coming in that I can use to flex and really build out that what we call a banking partnership. They're going to see that as, remember, the internal score with banks and financial institutions. It's not just your personal credit, but it's also your cash flow moving in through the accounts from both the revenue and the deposits that you're making. But then the second thing is, I know that if I am exiting a cash flow cycle, I can also use that to my advantage because now I have more liquidity inside of the bank. You start to run into no man's land when you don't know your numbers and when you don't actually understand what type of financial institution you're partnered with. You could be partnered with a financial institution that is heavily liquidity based, meaning they want to see a lot of cash moving into the account. Or counteracting that, you could be partnered with a financial institution that, regardless of how well positioned your business is, how much cash flow you have, what type of industry you're in, they just flat out aren't in a position right now to want to extend capital. This is where you start to see banks pull back. They say, hey, instead of 1 year tax returns, we want to see 2 years of tax returns, personal financial statements, and instead of your credit having to have been a 700, we want to see a 750 credit score. Similarly to kind of like what you see in the real estate market, where it goes, and this happened a lot during COVID, where I think it was Chase. They went from you can just get a conventional loan at like a 720. They bumped that sucker up to like a 750, 760, 20% down because it was one of the ways that they can mitigate the risk. It's the same thing here, which is why you want to have your eye on what your business is doing, but then also what the banks are looking at. And I like to think of this in quarters. So this quarter, what are banks doing? What are they looking at? Next question is, how can I protect my primary entity from appearing high risk if I have other high risk businesses? I think we already hit this one at the top. Does the age of my EIN directly impact how much business credit I can get? Yes. There's essentially two different, I say, dates that financial institutions are going to look at and that you want to pay attention to. The first date is going to be the date that your entity was structured. In this case, it's going to be the EIN of the business. That's like marker number one. Marker number two is going to be the age of your business bank account. The reason why those two markers are important and why I actually use that as a blended model whenever we're helping clients get access to business capital is because if you have a business entity and the age is 8 years, 9 years, and you think that you're just going to walk into a bank or credit union and you're going to get some of this like no doc stuff that you see all over the internet, well, guess what? You start to fall into like the land of diminishing returns, which means if you go into like 7 years, 8 years, 9 years, you've never filed your taxes, there's no cash flow running into the account. It doesn't matter how old the entity is. It's starting to look like, hey, man, this is a ghost entity. Like, we're not actually doing anything with this business, right? But then the second thing is if you have an entity and in that entity is actually starting to rain around me, which is pretty cool. I'm covered here in the canopy, so I guess I'll be with us here in the next couple minutes until this rain passes. But if you have a business entity, so the EIN, but you've never opened up a business bank account at all, remember there's two scores. You have the score with your business credit score, which is like of the business. You have your personal credit score, so I can actually say three scores. Your personal credit score, which is what you're going to use to personally guarantee the debt. And then the third score is internal scores, which is bank ratings. This is like the way that they calculate this is by looking at how much cash you have flowing either through the account or how much you have sitting in the account at any given moment. This is why you don't just want to open up an entity blindly. And if you've done this already, then like this is how we've seen it done. This is how I see it. Like there's a thousand ways to skin a cat, but again, this I'm just going off of experience, off of what we've done with our clients. Let's start building up that ledger with that financial institution so that this entity doesn't appear as a ghost entity, because the older it gets, it actually starts to counteract the reason why you opened up that business entity altogether. And then the last question is, can changes in the UCC filings impact my ability to secure new lines of credits without me knowing? 100%. I've mentioned this before in the past, and I'll say this again. You're going to have two different types of UCC filings that you're going to monitor. You're going to have your good standing UCC filing, which is done through UCC 1. And then you're going to have a bad standing, which means that you are either late on your payments or they haven't been able to collect on it for whatever reason. Can you still get access to capital and build out your funding for your entity if you have UCC filings on your business credit report? Of course. I mean, we do it all the time with our clients, but here's like the caveat. We monitor, are these in good standing? And if they're not, how can we get them into good standing? There's a couple ways that we do this. We take a look at the payments. So is the payment history reporting correctly? We take a look at the debt. Is the debt actually like, is the business that has that UCC filing attached to them, does that actually belong to them? And then number three, is it a dated debt? Meaning, is the UCC filing that's placed on my business record, so in this case, like an LLC, is it something that I already paid? Because then at that point, I'm going to start working on removing that off of my business credit profile, because it is going to increase my approval odds later on down the road, especially as I start to layer business lines of credit and SBA type of funding products. And by the way, if any of this sounds foreign to you, or if you have no idea what we're talking about, highly recommend two things. Number one, take a look at our content. We have a lot of in-depth videos on me breaking down more to depth some of the concepts that I spoke about. But number two, if you actually need help with any of this, book a call down below with our team. We'll take a look at where your business is, if there's a way that we can help you put a funding system into place so that you can get access to capital predictably and sustainably. If there is, we'll let you know right there on the call. We don't take on everyone that jumps on a call with us just because we have the bandwidth. Like we can only take on so many clients, and we're really good at what we do. So we only like take on clients that we know we can help. And so if you want to learn more, tap where it says, or actually tap on the, I was gonna say tap where it says learn more down below, like a Facebook ad, but tap where it says on the bottom, insideinnercircle.com. You can book a call with our team. It is pinned as the first comment, and then it's also pinned as the description. Take a look at your business and see how we can help you get access to the capital that you need.